All right, Addy John here, and I need you fully locked in for the next few minutes. What I'm about to explain is not speculation, not theory, and not another abstract business cycle story you can afford to ignore. This is a real-time liquidity mechanism that is actively draining cash out of the real economy right now, and it is destroying small businesses at a speed we have not witnessed since the 2008 financial crisis. Between January and December of 2025, more than 52,000 small businesses filed for bankruptcy in the United States. That represents a 34% increase year over year. But here's what the mainstream business media is deliberately not explaining. This wave of failures has nothing to do with poor management. It has nothing to do with changing consumer tastes, and it has nothing to do with business owners suddenly becoming incompetent. What we are seeing is the result of a structural liquidity drain, a breakdown in the credit system that small businesses depend on to survive. Regional banks, which provide roughly 80% of all small business lending in the U.S., are pulling back aggressively. They are tightening lending standards. They are reducing or canceling credit lines. And they are doing it because their own balance sheets are under severe stress driven by commercial real estate losses and ongoing deposit flight that never stopped after the Silicon Valley Bank collapse in March 2023. What we are witnessing right now is a slow-motion credit seizure in the small business sector, and what makes this crisis fundamentally different from 2008 is that it's happening quietly. There are no dramatic headlines, no emergency bailouts, no visible policy response from the Federal Reserve or the Treasury. The system is allowing small businesses to fail in order to preserve the banking system. If you own a business, if you employ people, or if you have capital sitting inside regional banks, you need to understand exactly what is happening, because waiting is no longer a neutral decision. Over the next 25 minutes, I'm going to walk you through the mechanics of this liquidity drain. I'm going to show you the historical patterns that prove this process is not new, and I'm going to lay out 3 asymmetric strategies that allow you not only to protect your capital, but to position yourself to acquire distressed assets at generational valuations. By the end of this breakdown, you'll have a framework that most business owners won't understand until they're already filing Chapter 11. So stay locked in, because this is the kind of information that separates people who survive systemic stress from those who get wiped out by it. Before we talk about the current crisis, you need to understand the foundational framework that governs how liquidity actually moves through the economy. Most people think businesses fail because they aren't profitable. They assume that as long as revenue exceeds expenses, a company is safe. That belief is dangerously wrong. Businesses do not fail because they lack profitability. They fail because they lose liquidity. A business can be profitable on paper and still collapse if it cannot access cash to meet payroll, pay suppliers, or service debt. This is known as the liquidity mismatch problem, and it is the silent killer in every credit contraction throughout history. Here's how it works. Small businesses operate on thin margins and uneven cash flow. Revenue often arrives on net 30 or net 60 terms, while expenses, payroll, rent, utilities, supplier invoices are due immediately. To bridge that gap, businesses rely on credit. That credit might be a line of credit from a regional bank, a business credit card, or invoice factoring. That access to credit is oxygen. It keeps the business alive between the moment work is delivered and the moment payment is received. When banks tighten lending, when they reduce credit limits, raise interest rates, or refuse to renew loans, that oxygen gets cut off. The business may still be generating revenue. Orders may still be coming in. The operation itself may still be viable. But without liquidity, the business cannot function. Obligations get missed. Workers get laid off. Vendors stop shipping. And eventually bankruptcy becomes unavoidable. Not because the business failed, but because the credit system failed. This is exactly what is unfolding right now across the United States, and the scale of it is being hidden by how the data is reported. The core thesis of this analysis is simple and critical. We are still in a regional banking crisis. It never ended. It just disappeared from the front page. The stress that destroyed Silicon Valley Bank, Signature Bank, and First Republic in 2023 did not vanish. It spread. It embedded itself into the balance sheets of hundreds of regional and community banks. Those banks are now quietly deleveraging by cutting off small business credit. This is creating a two-tier economy. Large corporations with access to capital markets and investment-grade credit can still borrow at reasonable rates. Small businesses that rely on regional banks are being systematically starved of capital. The result is a wave of bankruptcies that is accelerating, not slowing. And if you understand this dynamic early, you can see the asymmetric opportunity forming: distressed operating businesses, commercial real estate selling at deep discounts, private lending opportunities to borrowers who are creditworthy but locked out of traditional banking. But timing matters. Once this becomes obvious to everyone, the window closes. To understand where this leads, we need to look backward, because this exact pattern has played out before, with devastating consequences for those who failed to recognize it early. The first historical parallel is the banking collapse between 1930 and 1933 during the Great Depression. Most people remember the 1929 stock market crash, but that wasn't what destroyed wealth. The real damage came in the 3 years that followed, when the banking system itself collapsed. Between 1930 and 1933, more than 9,000 banks failed in the United States. These weren't Wall Street investment banks. They were local institutions, community banks, savings banks, and regional lenders that served Main Street. When those banks failed, millions of Americans lost access to their deposits. But here's the crucial detail that history books gloss over. Those failures followed a very specific sequence. First, banks that had concentrated lending in real estate and agriculture saw loan defaults rise as asset prices fell. Second, to protect their capital, those banks stopped making new loans and began calling in existing ones. Third, businesses that depended on those credit lines could no longer operate and began defaulting, creating even more losses for banks. Fourth, depositors noticed the stress and began withdrawing funds, forcing banks to sell assets at fire sale prices. And fifth, the entire credit system seized, triggering a deflationary spiral that lasted for years. The individuals and businesses that survived that era were not the ones waiting for confirmation. They recognized the pattern early. They moved deposits out of weak banks. They reduced reliance on bank credit. They raised private capital, and they positioned themselves to buy distressed assets, land, equipment, entire businesses, at fractions of replacement cost. The lesson from the 1930s is clear. When the banking system is under stress, waiting for headlines is fatal. By the time the crisis becomes obvious, optionality is gone. You must watch leading indicators, loan growth, credit standards, deposit flows, and act while you still have flexibility. The second historical parallel is the savings and loan crisis of 1989 to 1992, and this one is even more relevant to today. In the 1980s, savings and loan institutions were the primary lenders to small businesses and real estate developers. They expanded aggressively during the boom years, especially in commercial real estate. When the economy slowed and property values declined, those loans went bad. By 1989, hundreds of S&Ls were insolvent. The government responded by creating the Resolution Trust Corporation, whose job was not to lend, but to liquidate. Over the next 3 years, 747 savings and loan institutions collapsed. And here's the key point. During that period, small businesses lost access to working capital almost overnight. The RTC did not renew credit lines. It did not make new loans. It sold assets. Businesses that still had customers and revenue were forced into bankruptcy, not because operations failed, but because liquidity vanished. That bankruptcy wave peaked 2 to 3 years after the crisis began. The investors who created generational wealth during that period understood the liquidation cycle. They raised private capital. They bought distressed real estate at 30 to 50 cents on the dollar. They acquired operating businesses with solid fundamentals but broken balance sheets. They recapitalized, held through recovery, and exited at multiples once stability returned. The lesson from the S&L crisis is simple. Liquidity drains create asymmetric opportunity, but only for those prepared with capital, patience, and timing. Now, with that historical framework in place, we can turn to what is happening right now inside the regional banking system and why this time is no different. Now, let's bring this framework into the present and break down exactly what is happening inside the regional banking system today, because this is where theory turns into real-world damage. The current stress cycle began in March 2023 with the collapse of Silicon Valley Bank. SVB was not a traditional Main Street lender. It primarily served venture capital firms and technology startups. But the mechanism that destroyed it is the exact same mechanism now pressuring hundreds of regional and community banks across the country. Silicon Valley Bank held a massive portfolio of long-duration treasury bonds and mortgage-backed securities purchased when interest rates were near zero. When the Federal Reserve began aggressively raising rates in 2022 and 2023, the market value of those bonds collapsed. SVB wasn't insolvent in the conventional sense. It owned assets. But those assets were suddenly worth far less than the deposits it owed to customers. Once depositors realized this mismatch, the reaction was immediate. More than $40 billion was withdrawn in a single day, triggering one of the fastest bank runs in U.S. history. Signature Bank and First Republic followed the same path within weeks. But here's what the Federal Reserve and regulators did not clearly communicate. Silicon Valley Bank was not an isolated case. Across the U.S. banking system, hundreds of regional banks are holding similar underwater bond portfolios. According to FDIC data, by the fourth quarter of 2024, U.S. banks were sitting on over $500 billion in unrealized losses on their securities holdings. These losses don't appear on income statements because the bonds are classified as held to maturity. On paper, they only become a problem if the bank is forced to sell them early, but that's exactly the risk. If depositors withdraw funds, if liquidity pressure increases, banks are forced to sell assets. And the moment those bonds are sold, unrealized losses become real losses. Capital gets wiped out, confidence collapses, and the bank either fails or scrambles to raise emergency capital at punitive terms. Regional banks understand this risk, and their defensive response has been clear. They are conserving capital by cutting exposure to risk. Small business lending is considered high risk. Default rates are higher than residential mortgages or consumer auto loans. So when banks tighten, small businesses are the first to be cut off. Credit lines are reduced, renewals are denied, interest rates are raised, collateral requirements increase. The data confirms this behavior. According to the National Federation of Independent Business, the percentage of small business owners reporting that credit was harder to obtain jumped from 6% in early 2022 to over 32% by late 2025, a more than five-fold increase. At the same time, average interest rates on small business loans rose from roughly 4.5% to over 9%. For a business operating on 5 to 10% margins, that increase alone can determine whether the business survives or fails. Now here's the quiet mechanism that makes this situation even more dangerous. And most business owners don't recognize it until it's too late. When banks tighten credit, they don't announce it publicly. There are no press releases, no warnings. The change happens quietly, one loan officer decision at a time. Applications get declined, credit limits are reduced, renewal terms suddenly change. Individually, these look like isolated cases. Collectively, they represent a systemic withdrawal of liquidity. The Federal Reserve tracks this behavior through its Senior Loan Officer Opinion Survey, and the most recent data from late 2025 shows that over 60% of banks tightened standards for small business commercial loans, the highest reading since the 2008 financial crisis. This is not a forecast. This is not hypothetical. This is happening right now, and here's the cascade effect. When a small business loses access to credit, cost-cutting becomes immediate. Workers are laid off. Supplier payments are delayed. Inventory orders are reduced. Those laid-off workers cut spending. Suppliers face cash flow pressure. Manufacturers and wholesalers see declining orders. The contraction spreads outward through the economy. A business may survive temporarily by burning savings or selling assets. But without restored credit, runway eventually runs out. Obligations go unpaid. Bankruptcy follows. The bankruptcy data confirms this trajectory. In 2025, total U.S. business bankruptcy filings reached 52,983, up from roughly 39,000 in 2024, a 36% year-over-year increase. In just the first quarter of 2026, more than 15,000 filings have already occurred. At that pace, total filings this year are on track to exceed 60,000. For context, during the 2008 financial crisis, business bankruptcies peaked just below 64,000. We are approaching that level without a stock market crash, without a housing collapse, and without mass media alarm. This is a quiet crisis, and that makes it more dangerous. Now let's move to positioning, because understanding the problem only matters if you can act on it. This environment creates three asymmetric opportunities. The first is distressed business acquisition. When businesses fail, their assets don't disappear. Equipment, customer lists, intellectual property, trained employees, these remain. In bankruptcy, they are sold at liquidation prices. If you have capital and know how to underwrite distressed situations, you can acquire these assets at 20 to 40 cents on the dollar. The key distinction is between liquidity failure and business failure. A company with strong demand that collapses due to credit withdrawal is very different from one with a broken model or declining customers. Liquidity failures can be fixed with capital and restructuring. These acquisitions happen through bankruptcy courts, pre-filing negotiations, or distressed brokers. They require speed, balance sheet literacy, and discipline, but the upside is substantial, acquiring businesses at 1 to 2 times EBITDA that would trade at 5 to 7 times in normal conditions. The second asymmetric opportunity is hard money lending. Right now, thousands of profitable, cash flow positive businesses cannot access bank credit. They are willing to pay 12 to 18% interest with strong collateral to survive. This creates opportunity for private lenders. You're not competing with banks, you're replacing them. The key is conservative underwriting, low loan-to-value ratios, tangible collateral personal guarantees, and clear repayment paths. Properly structured, these loans generate 15 to 20% annual returns, primarily from cash flow, not speculation. In a credit contraction, this is one of the safest high-yield strategies available. The third asymmetric opportunity is physical gold and silver. This is not disconnected from small business credit, it's directly linked. As trust in regional banks erodes, business owners are pulling deposits, liquidating assets, and seeking liquidity outside the banking system. Gold and silver are not just inflation hedges, they are liquidity hedges. They function when credit fails. Central banks understand this. In 2025, they added over 1,000 tons of gold to reserves, the highest level in more than a decade. China, Russia, India, and Middle Eastern sovereign funds are accumulating aggressively. For individuals and business owners, the strategy is straightforward. Allocate 10 to 20% of liquid capital into physical gold and silver, held directly or in allocated storage outside the banking system. Not ETFs, not paper claims, physical metal. Now let's talk about action, because this window will not stay open. First, if you own a business, stress test your credit access immediately. Call your bank, understand renewal terms, review covenants. If you sense hesitation, line up alternatives now. Second, if you have capital, start building a distressed deal pipeline. Work with bankruptcy attorneys, monitor filings, build broker relationships. Third, reduce exposure to weak regional banks, especially those with heavy commercial real estate exposure and large unrealized losses. Diversify deposits. Stay below insurance limits. Fourth, build your precious metals position if you haven't already. This is non-negotiable in a contracting credit environment. And finally, stay informed. This crisis is evolving quarter by quarter. Ignore narratives, watch data. Small businesses are failing at crisis levels. Credit is contracting. Regional banks are under unresolved stress. The liquidity drain is real and accelerating. So here's my question for you. If you own a business, have you seen tighter credit in the last year? If you're an investor, are you positioned or still waiting? Let me know in the comments. And if this breakdown added value, subscribe and turn on notifications. We are tracking this crisis in real time. Share this with anyone who needs to hear it, because the people hurt most will be those who didn't see it coming. The pattern is forming. The opportunities are emerging. The only question is whether you act before the exits close.